Thank you very much, Andrew, for having us this morning. Let me kick off. Welcome, Andrew, for your time. So Yinson Production is a remarkable story of transformation. From a relatively modest beginning as a Malaysian transport company, it's grown to one of the world's leading independent FPSO leasing platforms. In just over a decade, since entering offshore production in 2011, Yinson Production has built a fleet of 8 operational FPSOs, with more under construction and delivery in key deepwater markets. Right? So key highlights, you have FPSO John Agung 4, which marks their global credentials in Ghana back in 2017. FPSO Ananeri marked their entry into Brazil, the largest FPSO market, and most recently FPSO Agogo, which was recently delivered ahead of time, deepened its African footprint with Azul Energy. Right. On the financial side, Yinson has delivered revenue of $606 million with a very impressive contract backlog of $19.6 billion as of Q1 26, underpinned by high uptime and reliable operations. The scale and credibility has enabled Yinson Production to tap the global capital markets in very innovative ways, which is exactly what we are here to talk today, right? Andrew, before we go into the accolades, right? When we met several years ago, Yinson Production was growing from strength to strength, winning contracts. But this came at a time where financing landscape was challenging. You know, it was an exit of export credit agency. There were growing concerns from the financiers' side around energy transition. We saw a pullback from a number of European banks. I want to peel back the thought process behind the strategy that led to the accolades you're enjoying today. What was the vision driving your financing approach then?
Thank you, Kheng. I think at the time we had 3 vessels that were billion-dollar sized under construction at the time. And we realized that the pool of capital that is available for construction, we were sort of starting to hit that upper limit from a single borrower perspective. And we realized we needed to reevaluate how we deployed that kind of capital. As a long-term contracted business, one of the potential futures of the industry that Kevin was talking about, we realized the only way to grow is to construct more assets. We can't charge a higher day rate on a market basis. And so when you think about how we finance those constructions, that capital, that construction capital, is really our growth capital. That is, I think, the key realization we had a few years ago. And so for us, it became incredibly important to protect that growth capital. The longer we had that specific growth capital deployed in a long-term financing, then that was a dollar-for-dollar reduction in our potential for funding future growth. And so the strategy became, how do we judiciously protect our lenders, and how do we accelerate the velocity at which that capital can be recycled so that we can take that same dollar and invest it in a new ship. So the strategy was protecting that capital.
No, thank you for that. So, I mean, let me build on that. So we worked on financing on FPSOs in Brazil, and subsequently, when those assets were operational, you came out to tap the project bond market. Most recently, you raised $1.16 billion in project bond, which is the largest, I believe, for the kind in Asia. Walk us through, that journey behind, speaking to banks and then going to capital markets.
Yeah. Our first bond was a Nordic bond, and that priced at a yield of around 10%. I think at the time, a lot of people asked me, why are you spending 10% to raise US dollar funding? Just get it from the banks. It's so much cheaper. We actually used that money to repay an existing syndicated loan that was arguably cheaper priced than the bond. And why did we do that? Exactly to follow the strategy that we'd laid out. We returned $500 million of capital to our core relationship banks. That means we're adding $500 million of capital, of growth capital, back into our pockets, if you like. We've parked now that bond in the Nordic capital markets. That'll be there for 5 years. And the money that we've returned to banks can then be used to fund our next asset, and our next asset, and our next asset. I think that was the key realization. Actually, the cost, we're not solving capital on an individual asset-by-asset basis. The traditional model is, let's say we sign a new contract, we want to build a new vessel, and we'll just go to the market and find the cheapest possible cost of funding. That probably comes from our relationship banks, from Standard Chartered and others. But we realized that that then prohibits us from funding the subsequent vessel or the subsequent vessel. So you've got to take a fleet-wide approach to how you raise your capital. Just having optimizing on a tranche-by-tranche basis for a cost reason is not necessarily strategically the right balance here. So similarly, when we went to the 144A bond market, we were returning capital to our construction lenders. Again, the first bond we raised was priced at, I think, 8.9%, and each time we go back to the bond market, the prices come down. And why is that? Because they start to get familiar with us as an issuer. You can't expect your very first deal to be absolutely, best priced, finely tuned, best in the market. But as you develop a reputation, as a strong issuer, somebody who is continually delivering what you promise, continuing to pay your coupon, you will get finer and finer pricing. So if you like, it's sort of taking the bitter medicine now so that you have a healthier balance sheet in the future. And I think our most recent bond for the Maria Cataria priced substantially lower, and now all three of our bonds are trading around the 8%, even below 8% yield. So again, substantial improvement over time through multiple issuances.
Fantastic. I mean, a client that is not solely focused on pricing, that's music to my ears and a lot of investors' ears. But let me, switch hats a little bit. How do you then explain this to your investors, to your shareholders, that, look, I'm going to tap, liquidity is more expensive at that point of time. Yes, you've demonstrated now that pricing has come down, but take us through that conversation to your shareholders, to your investors, to your management team.
Yeah, that's not an easy conversation, Kheng, and I'm sure everyone in this room has had a similar conversation. I think, and it's helped that we have been, we are part of a listed conglomerate, but we are not the listed entity itself, so there is less focus on sort of a quarterly delivery of earnings. I think the second point is our business is built on long-term contracted revenue. And so we think not just in immediate quarterly or yearly cycles, but we think in long-term 10, 15, 20-year super cycles. And when you have that perspective, what's more important than optimizing today is optimizing over the life of the contract. Particularly with these bonds, we've issued 19 and 18-year bonds, respectively. That means we've monetized substantially all of that contract value today. We don't have to worry about refinancing. And refinancing for an FPSO is a little bit more nerve-wracking than for your typical ship, because there is no liquid market like there is for a tanker or for a bulk carrier. We can't sell our asset to monetize it if we really hit that wall of maturity. So as soon as we see a current debt on our balance sheet, that really makes me worry. And so being able to do this early, and again to the point around capital velocity, to get these structures in place early means that we satisfy ourselves, but also for our stakeholders, they're comfortable that they can just sit back and earn that financial income on a steady state basis for the next 15, 18, 20 years without having to worry about, are the debt markets available? Can we issue? Are the banks still going to be there in 5 years? We eliminate all those concerns. And that reduction of risk, I think, is worth a handful of basis points.
Thank you. So you spoke about accelerating capital velocity, right? So, and you've talked about how it kind of returns value. Can you unpack that? Because, I mean, how do you respond to your critics that, in addition for saying, this could be expensive, but it also distracts from a management perspective? How do you kind of respond to that?
Wow, tough question. I think at Yinson Production, we don't see the finance team as just a bunch of accountants. We're not sort of there just to fill in the gap. We really see finance as a value driver of the business. We truly are a leasing business, and so leasing and being able to price that lease is a core part of what we do. Being able to price the lease is wholly dependent on the cost of your financing. Ultimately, we want to keep growing the business. We need to protect that growth capital. If that means we need to tap alternative sources of financing, which may be at different pricing, I think there is a clear justification for doing so. We are, in fact, improving our shareholders' value, because over the long term, we're not just optimizing a singular cost, but we're continuing to grow the pool of assets that they have. And that, it's a similar reason for why we did our structured equity raise. And again, it's about growing the pie. Our stakeholders will be happy, and we've had this conversation, to have a slightly smaller stake of a much larger pie. I think that is a more attractive long-term proposition than just trying to optimize a similar sized piece of asset.
Oh, thanks. I'll get to the structured convertible note a little bit, but traditionally finance is seen as a cost center. You argue that it's a value driver. How do you define that, right? As a value driver to the overall organization, is returning value to shareholders is something you've defined it. But can you unpack a little bit, and how does this link to the various instruments that you've tapped?
So I think the key is, rather than thinking about individual dollars, we think about the time value of money. And so within when we sign a 20-year contract, the sort of nameplate capacity of that contract, if you like, or the nominal value is maybe $5 billion. But when you NPV it back to today, you're going to get to somewhere around $2 or $3 billion. And for us is then, we think about the returns that we're going to generate through that contract, the costs we incur up front in terms of the construction. Of course, there's a little bit of O&M. And then through the life of the contract, the real lever we have is then how we continue to finance that contract and finance the original construction over those 20 years. To the extent that we can monetize that contract earlier, and if we do that through a bond, we're essentially taking future cash flows and recognizing them from a shareholder perspective on the day we issue the bond, that generally has a massive improvement on the NPV of the overall project, and therefore the returns that we're delivering to those shareholders. So we are able to bring forward cash flows, we're able to repay lenders and preserve our growth capital, and we're able to dividend up the excess proceeds because the debt capacity generally, when you stretch it over 20 years, increases.
Thanks for that. So you've talked about protecting the limits for your bank, for traditional bank lenders that have formed the base. You talked about accessing the capital markets that provide long-term capital at a particular cost. You've also recently gone in to tap a $1 billion convertible note, right? Can you share a little bit about the thought process of going and tapping the convertible note, bringing in, not only new partners but potentially shareholders into the company, and the thought process behind that?
It's been a very enlightening Marine Money Week for me, because I hear the rest of our industry is awash with capital, which is great to hear, and banks are lending it down to 100 basis points on the margin. Unfortunately, in the offshore space, that's not the case. And we're tinged with the brush of oil and gas as well as the brush of shipping, which means that certain lenders have exited. The pool of available liquidity to us continues to decrease. We realized, and we contrasted that against the state of the market, where we're seeing an increasing number of charterers looking for vessels, looking to develop their offshore fields. And we see that the demand for FPSOs is perhaps at an all-time high. So how are we able to capitalize on that demand? I think the key for us was, for the first time in our history and perhaps the history of the industry, we decided to raise the equity first rather than sign the contract first. So we ran this process to find some strategic investors to raise $1 billion that will help fund the next 2 or 3 massive FPSO constructions that we have planned. And that was an extensive process, and I think it was strategic in a couple of reasons. Firstly, we connected with the Abu Dhabi Investment Authority, and that essentially created a Middle Eastern nexus for us. So again, we're unlocking yet another pool of capital. We did so with the Nordic markets, and now with the Middle Eastern banks and the Middle Eastern private capital. Now that they see that their sovereign wealth fund has joined forces with Yinson, they're now much more willing to entertain a conversation around perhaps opening an FPSO strategy or opening an offshore strategy, and they're willing to invest the time and hopefully the capital to learn and invest and grow alongside us. I think secondly is we did this as a structured product. That gives us, one, the flexibility to choose to pay, whether we pay in cash or in dilution. We had the support from our core shareholders that they would prefer some dilution so that we can continue to grow the pie. Essentially, again, this is another form of growth capital for us, and this helps us grow the asset base and grow the value of Yinson production as a whole. I think, thirdly, it is a precursor, hopefully, to something even larger down the track. So this brings with it some financial discipline, and we have private equity capital in there as well, British Columbia Investment, RRJ Capital. We now have a board that comprises a diverse group of people from our existing shareholders, from our new investors. I think that adds another layer of financial discipline, particularly in terms of how we evaluate and how we price new projects. They're obviously very concerned that we continue to deliver returns to shareholders, and this essentially gives us a nice hurdle to aim for. So we've put things all into place. We now have the equity capital solved for, now that we've raised $1 billion there. We have preserved liquidity in the bank market, so we have an untapped pool of growth capital from bank lenders in terms of senior financing. All we need now is contracts, and we see that the market is ripe with potential contracts. And so we really are poised to capture the growth that will come from this next stage of the FPSO market.
Thanks, Andrew. So, I picked up on the point where you've addressed the crowd, where there's plenty of liquidity chasing after the shipping market. I sense a tinge of jealousy on what Yinson is going through, but yet you've managed to tap both the banking market, the capital markets, and now with strategic investors. I'll give the stage to you. You have banks here, investors here that might not have taken time to understand the industry. What's the sell?
I think the traditional model of trying to optimize each individual financing is a very singular-minded focus, and I would encourage everyone to take a broader view around your entire fleet, not just as it stands today, as you hope to see it over the next 5 or 10 years. We want to see a well-capitalized industry. We want to see our peers also raising capital. A well-capitalized industry is a healthy industry. And a healthy industry means there will be competition. And competition is good for us on the basis that it gives our clients, the charterers, the confidence that there is a robust, competitive lease and operate market. It gives them the confidence to continue to choose lease and operate as the correct model for financing FPSOs.
On that note, then, what lessons can your peers or your industry take away from the experience that you're going through now?
I think, have the difficult conversation, challenge your stakeholders, try to choose markets, whether it's the Nordic capital market, whether it's Chinese leasing, whether it's private credit. Maybe they do have higher return thresholds, but think about them. It preserves liquidity in other areas. It diversifies your funding sources. As we've seen with Chinese leasing in the shipping market, right now, a lot of those deals are having to be unwound because of external factors. There's going to be a press on other forms of liquidity. But if you've pre-positioned yourself, you're ahead of the curve a little bit. I think keep your mind open, keep exploring new potential pockets of liquidity, keep coming to Marine Money Week Asia because you hear about all these different markets, and have those difficult conversations. It's not just about every basis point, but it's about the fleet as a whole.
Great. I mean, music to my ears, if you can. So I've taken a number of interesting messages. You've kind of grown from strength to strength. It was a difficult journey, and you've tapped various pools of liquidity, navigating not only a difficult industry, but also the overall landscape of geopolitical energy transition. And here you are today, largest bond in the market, award-winning deals for a go-go across the board. If you had to leave this room with one message, looking forward, what would it be?
Yeah, you mentioned a go-go. I would just touch upon that. Even within a construction financing, again, we could have just solved it in the bank market, but we structured a multi-tranche facility where we also had private credit come in pari passu with traditional bank lenders. Again, we're expanding the pool of liquidity available through an unconventional structure. Again, it's the first time a multi-tranche facility has been used in an offshore financing, and it's not easy. And you know, for all the lawyers in the room, it's great for them. We incur massive fees for all the bankers. It's great. We paid you a coordination fee. Thank you very much for the hard work, Kheng. You know, these things are not necessarily cheap, but they do expand your overall pool of liquidity. And from from a project return perspective, it's better to be pound wise and penny foolish rather than the other way around. Sometimes it's okay to spend a few fees in order to get the long-term win. So keep your mind on the prize. Think in super cycles, not short-term. Be pragmatic.
Thank you very much, ladies. Andrew, thank you so much for your time, for sharing your thoughts.